What's going on, everybody? It's Steve here, and today I want to talk to you about 5 tech stocks that skyrocket your portfolio. A couple of these tech stocks I'm gonna mention today I have, and other ones I don't, but I'm considering it. So I hope you enjoy the video. I wrote these down on notes because I'm in the middle of nowhere. I don't have my computer in front of me, so bear with me while I read and give you a little bit of input of why I like these stocks. Stock number one is Nvidia Corporation. Now they're in the semiconductor industry, and the sector that they in is IT. Now the thing about Nvidia, I've had Nvidia personally for a few years. I got it when it was about $120 a share. That's when I brought in, and it's done nothing but produce for me. I like the company. I like the the values of the company. I like how, Nvidia has it. They used to work with iPhones. Used to have Nvidia chips in the iPhones, but I'm not sure if they still do. But let me tell you a little bit about the company. It has a market cap of 450 billion. The company segments include graphics, like for gaming, computing, and network systems. They have an AI platform, data platform. They deal with three-dimensional software, gaming graphics, as I mentioned before, robotics, among other things. As a tech play, I really like Nvidia because it's steady. Now, I mean, amongst all the volatility and it's dropping, once I got it at 120 or so when I first jumped into it, I always was wondering like if it was ever going to go back, because we had the time last year that the market was just taking off, and it had a 52-week high of $346.47. That's like today, 1 year ago today, this is how much the stock was. So I didn't know if it would ever going to come down. The price is similar to when I brought it at. I was glad I brought it at 120, but I never knew if it was going to go back to that size. So recently I picked up some shares. It's trading today, like I said earlier, at 178.79 as of this recording. So it's something definitely worth adding to your portfolio, because if it goes back up to these 52-week highs, it's a lot of gains for you. It does pay a dividend, which most tech stocks, they're usually growth stocks. They don't really pay dividends. If they do, it's very minute, such as the case with Nvidia at 16 cents a share, or 0.09%. So that's Nvidia right there. But it's a good company, and I really like it, and I'm glad I got it in my portfolio. Second, what I'm going to talk about is something everybody knows is Google, or Alphabet company. And it's trading today because they just had the 20-to-1 stock split. Excuse me, I got wind blowing all over. They just had the 20-for-1 stock split a couple of days ago, and now it's trading at $113.61 as of today, and it's off its 52-week high of $151.55. Now, Google has a market cap. It's one of few companies that are over the $1 trillion market cap, and they're at $1.5 trillion, which is astronomical. The sector is communication services, and the industry is interactive media. And as you all well know, Google is one of the biggest search engines. Everybody knows what Google is, especially with the term, hey, Google it. If you want to know answers to something, it has one of the biggest search engines. But a lot of people don't know that Google right now, with the 20-for-1 stock split, has a PE ratio of 20. And now that's a little high, because I try to stay under 15 for PE ratios, price to earning ratio. But at 20 and $113 right after the stock split, it's really worth considering. Like I own Google, and I bought more shares of Google as of prior to the stock split. Will I be adding more shares to it? Yeah, I will. Most likely I'm gonna wait for the next earning call, see how it turns out, and then I'll make my decision. But I do have strike prices on Google with it just split. A lot of times when stocks split, they might go up a little bit and then it might drop, because the price is not like it was, because Google used to be $3,000 a share. If anybody know, some of you guys know that. But I mean, it just flipped. Like, not to get off the subject, like with AT&T. AT&T split the stock, right? And they separated from Warner Discovery, and the stock just teetered for a while. But Hopefully with this, it'll do the same thing, and it drops. If it drops below, like my strike price right now with Google is like 105. If it drops below 105, then I'll buy some more, like hands down, with my cash reserves. But Google is known, they have a lot of, it's the world's largest search tool. They have different things in Google, like Google search page, which we just talked about. Google Maps, everybody knows that or is familiar with that. Gmail, of course, Google Workplace, and the Google Cloud. Now the thing about Google, it doesn't pay a dividend, but I mean a lot of tech stocks don't, like I previously mentioned. But that's number 2, Google. So far we got Nvidia and we got Google, 2 good companies that I like and I have in my portfolio. Company number 3, excuse me, is a personal favorite of mine, Intel. I love Intel, and I'll tell you why. Intel is trading right now at $40.26, and it's off of a 52-week high of $56.54. The reason why I like Intel, is Intel is up and coming, and they got a lot of stuff in the works. As far as like they just upped their dividend like a couple of days ago. It's still in the sector it's in is still IT. They deal with semiconductors, computer chips. Some of y'all heard of Intel processors, and which are basically chips that make the computers go faster and perform better and things like that. The thing with Intel, with them being chip makers, is they're in a lot of competition. Now, just like Nvidia, they're chip makers too, but as far as putting them both in your portfolio, I think a lot of what they do is the same, but their customer clientele and their troubleshooting their thing is somewhat different. So I think they both will work in a portfolio. Now, the thing about Intel that I really, really like is it's trading at a PE ratio of 6, which is really good. So I've been stocking up on Intel. Like I'll buy Intel as long as it stays under $50. Because I mean, what I do is like I'll take stocks, and if it's a really good buy, I'll just buy it. I'll keep buying, and then like I might have a 5 or between $5 and $7. I might jump and say, okay, well if it goes up $7 because I think the company is worth more than that, and I have a little bit of cash, like every few days I'll watch, and I'll jump in, buy a little bit more to keep my dollar cost average, stable. Yeah, with it having a P ratio of 6, another thing I like, and this is the biggest thing, that's why I like buying Intel, is because they're running right now an attractive dividend of 3.6% at $1.46 per share. And that's all right with me. That's number 3, Intel number 3. Number 4. Now these 2 stocks I don't have, but I'm considering them, especially this one right here. Number 4 stock is PayPal Holdings, and it's trading right now at $81.95. And it's off of a 52-week high. Listen to this, at $3.10. $310.16. It's really hot today. I'm trying to get through this, but I want to get this message out. The market cap for this is $95 billion. That's their market cap. The sector is IT and IT services. Now, PayPal Holdings, a lot of people know, it's basically a tech platform that you can use, as a customer or as a company, where you can make transactions with people, like e-commerce, basically. They own the Venmo app where you can send money. It's kind of like Zelle, the Venmo app. They have credit cards, which I didn't know about, and they said they have ownership in certain cryptocurrencies. It has a P/E ratio of 25.7, but I mean, with the fluctuation in the market, a lot of companies that are good companies have high PEs, and it's just how it is. But yeah, I like PayPal. I don't see it going anywhere no time soon, like as far as like being outbid or outdone. I mean, it's a $95 billion company, and it's established already. And a lot of people, and it's worldwide, a lot of people around the world use it, not just in the United States where we at. So that's number 4, PayPal. Now, PayPal does not pay a dividend. Let me add that too. But that's PayPal. Now, last but not least, and this is the one I made last, is the Lucid Group. Now, a lot of y'all don't know what Lucid is. Lucid is like Tesla. It's a Arizona-based company. I think they have one big factory that they sell directly to the consumer, and they sell EV, electronic vehicles. Their only car right now, they have a couple other models in production, but their only car that they have is the Lucid Air, AIR. Now that car, I've seen it on, you can look on YouTube and see, the reviews about the car. But the car looks really nice. It's more like a luxury type of car. It kind of reminds me of a Lincoln. Remember the old Lincoln, the Lincoln cars, where they're very luxurious? It's really nice. I think it starts off like at 160,000 now. Now, the thing with me with these electronic vehicles is, well, with Lucid only has one plant. And their EPS, their earnings per share right now are negative $1.18, meaning they're not turning a profit. Now, a lot of people might be like, oh man, Steve, that doesn't sound right, and this and that, but you gotta remember, 2-3 years ago, Tesla was in the same spot. They were making cars, they had cars on the road, and all this, and they be like, man, how they not making money? Operating costs, and they're opening up different things, and they gotta put money back into the business. But it wound up being lucrative for them. Now, I'm not saying Lucid is going to be the next Tesla, but Lucid has a lot of promise. And with the EV market, which is electronic vehicles, the electronic vehicle market then doubled last year in growth. And it's a lot of room to where other people can eat other than Tesla. So, and this trades at $21.43 compared to $700, $800, $900, sometimes $1,000 with Tesla. Now, in my portfolio, because I'm thinking about buying this, in my portfolio, I would probably put 2% of my money in this, on my total portfolio, 2 to 3% tops. It's in consumer discretionary, and it's automobiles. Now, a lot of people might be like, oh, well, it's not a tech stock because it's in the car industry, but it's electric. The batteries are sophisticated. The guidance systems are sophisticated. Everything's electrical. So I mean, I just left it. I put it in the tech sector because it has a lot of growth potential. Now, unlike the other ones that are established companies with billion dollar market caps, now they have a $35.7 billion market cap. So it's not nothing to sneeze at. It's not a fly-by-night business. They have a lot invested into this, making this work. So, as far as me, this is just a growth play, to where, I'll jump in, buy a few shares, see how it goes, and I'll run it for about 3 to 5 years. Now, if it takes off and it still produces, it might kick off a nice dividend. Then who knows? But it's definitely something that I'm looking into, and hopefully you guys will check it out, and it might work for you, or you might consider it. But that's about it. Sorry about this. It's hot out here. Listen, that's it for me today. I appreciate you spending time with me as usual, and I'll see you in the next video. Remember to like and subscribe, and thanks for joining me. Take care.